All right, welcome to The Explainer. Today, we're unpacking what is genuinely one of the most fascinating structural shifts in the entire 2026 market, the unprecedented paradigm shift in memory stocks. If you follow the market at all, you know this sector has been making massive headlines lately. So today, we're going to break down exactly why this is happening, what the underlying data is telling us, and most importantly, whether this incredible momentum is actually built to last. So, are you too late to the biggest rally of the year? Look, it's a completely natural question. You see these massive run-ups and you get that sinking feeling of FOMO, right? You're thinking, man, I missed the boat. The party's over. If I jump in now, I'm just going to get burned. Well, let's dive into this, because the core analysis we're looking at today challenges that exact assumption head-on.
Because we're not just talking about standard market outperformance here. We're looking at staggering triple-digit returns in a single year. Western Digital, up 211%. Micron gained 254%. Seagate jumped 261%. And then there's the absolute standout, SanDisk, with a massive, mind-boggling 653% jump year-to-date. I mean, some of these stocks have literally more than sextupled. Normally, you look at those numbers and think, okay, the upside is definitely fully priced in.
But that brings us to an incredibly bold, kind of counterintuitive argument from Jim Cramer over on Mad Money. He looks at these exact same triple-digit gains, totally validates that natural skepticism, but then pivots to a completely different thesis. He says, while I acknowledge that I am not early, I do not think I am late. It's a fascinating perspective. He's basically arguing that the actual rules of the game have fundamentally changed.
Section 1. The Boom and Bust Trap. Historical Nightmare. You really can't appreciate Cramer's bullish argument without understanding the brutal history that has haunted memory investors for decades. It's like a bad movie you've seen 100 times, and it always happened in 3 painful steps. Step 1. A demand surge. Some cool new tech trend pops up. Memory chip demand spikes, prices go up, and everyone's making money. But then, Step 2. The overbuild. Manufacturers get a little greedy. They see these high prices and spend billions, literally billions, building massive new fabrication plants on pure speculation. And then, inevitably, Step 3, the crash. All those giant new plants finish construction, come online at the exact same time, and completely flood the market with supply. Prices collapse, profits evaporate, and stock prices tumble. Boom, then bust. Every single time.
Section 2. Why this time changed. 2 key arguments.
So, Cramer's entire thesis rests on 2 new pillars that break this historical trap: unprecedented demand and corporate supply discipline. Let's talk demand first. This isn't your typical fleeting tech spike. We're talking about the AI boom and the massive data centers needed to run it. Cramer leans on a really powerful point from Elon Musk, who has flat out stated that memory has become the key bottleneck to data center expansion. I mean, think about the weight of that. When the head of Tesla and SpaceX is telling the world that memory is the primary choke point for AI growth, that signals a structural, persistent shortage. The demand floor hasn't just moved, it's completely shifted.
But hey, demand is only half the equation, right? The real game changer, the reason that old boom and bust trap might actually be dead, is on the supply side. The old way was all about aggressively adding capacity on pure speculation, just desperately chasing volume. But the new way? It's all about discipline. These companies are now securing long-term customer agreements. They're literally locking in their margins for years before they even think about breaking ground on a new facility.
As Cramer emphasizes, they are basically building only to suit. The manufacturers have finally grown up. They've stopped throwing billions of dollars at megaplants just hoping someone will buy the chips down the road. Actually, scratch that. It's simpler. If they don't have a highly profitable, long-term contract signed and sealed, they simply do not build it.
Now, you might be wondering, if they aren't wasting all those billions on speculative mega factories, what are they doing with the extra cash? Well, they're handing it right back to the shareholders. SanDisk has a staggering $15.5 billion remaining under its share repurchase authorization. Seagate is working through a $5 billion buyback program. Western Digital added $4 billion to its plan just earlier this year. This is absolutely crucial because it proves the discipline is real. They're actively choosing to boost shareholder value instead of repeating the disastrous overbuild mistakes of the past.
Section 3. The top 4 stocks driving the rally.
Let's look under the hood of these specific companies, because these explosive gains aren't just hype or market froth, they are backed by massive, tangible improvements in how these companies actually operate. Look at SanDisk, they didn't just get a little bump. Their gross margins skyrocketed from a really anemic 26% a year ago to a jaw-dropping 85% today.
Seagate is sitting on a record gross margin of 52%. Western Digital improved from 41% to 54%. The takeaway here, when you secure long-term agreements and finally stop flooding the market with cheap supply, your profit margins absolutely explode.
But out of all these massive winners, Cramer has a very clear favorite, Micron, ticker symbol MU. In fact, his charitable trust just opened a brand new stake in the company, and the reason is simple. Out of the whole pack, he believes Micron is the poster child for this fundamental shift, transitioning out of that nasty cyclical trap and into a sustainable growth model, completely anchored by those long-term supply agreements.
So the crucial point is this highly aggressive claim from Cramer. He believes that even after climbing 254% this year, Micron could literally double again, a 2x return, before this boom is over. I mean, to look at a stock that has already nearly quadrupled and confidently say, yeah, it can go up another 100% from here, that shows immense conviction in this whole new supply and demand paradigm. Section 4. Risks to the rally. Acknowledging danger.
Now, we can't just blindly fuel the hype here. We have to look at reality. There are three major structural threats that could completely derail this thesis. First up, a data center slowdown. Cramer's entire call assumes AI demand stays red hot. If that AI build-out taps the brakes, the demand floor falls right out. Second, new capacity from Samsung. Cramer specifically called them out as a wild card. If Samsung decides to go rogue and aggressively ramp up production, they alone could flood the market and crush those beautiful margins. And third, the return of the classic overbuild trap. Yes, manufacturers are disciplined right now, but man, greed is a powerful force. They could absolutely abandon that discipline and start building speculative plants all over again.
However, Cramer has a really strong defense against that specific overbuild risk. You see, bringing a new fabrication facility online is not something you just do over a long weekend. It is a massive multi-year undertaking. Because of the sheer time it takes to build a plant from scratch, an immediate surprise overbuild crash is highly unlikely. That multi-year timeline basically creates a long, safe runway for current investors to ride this wave long before any new speculative supply could physically hit the market.
Which brings us to the core takeaway of this entire analysis. Cramer sums up his stance perfectly. Sometimes the opportunity is too great and you can't afford not to take it. Are there risks? For sure. Have the stocks already run up? Absolutely. But if the memory industry has genuinely fundamentally changed its behavior, if this demand is permanent and the supply discipline holds, then the risk of sitting on the sidelines might actually be way worse than the risk of jumping in. And that leaves us with the ultimate question for 2026. Will this AI-driven discipline permanently rewrite the rules of memory stocks, or is history just waiting to repeat itself? It is honestly one of the most fascinating investment debates happening right now. The numbers are staggering, the margins are very real, but human nature and corporate greed are formidable forces. You're going to want to keep a really close eye on those long-term supply agreements and gross margins, because they are the absolute key to knowing if this paradigm shift is here to stay. Thanks for joining me on this explainer. Keep learning, and as always, keep asking the right questions.